So, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks just for you. So all you have to do is just watching this video and decided if the following stock could be something for your portfolio. It doesn't get much easier than that. In return to that, please feel free to hit the subscribe button below and become part of the Monkey Stock Club family so you will never miss a video again. Please be aware that everything I say here is just my opinion, as I'm not a professional investment advisor. As you can see, I'm just a monkey, but nevertheless, I love to analyze stocks just for you. So let's stick around and discuss some numbers now. So, quick update on Twitter. Twitter stock crashed, and 5 reasons why after releasing the Q3 figures. So disappointing user base growth in Q3, negative free cash flow in Q3, and delay of mobile application promotion. Jack performance at the analyst call last week was weak, and the Twitter stock had risen far too quickly within the last month. Just take a look into the 6 KPIs of the high growth investing analysis that I used. So first of all, if we take a look into the enterprise value divided by the revenue, we got 8.5 as in figure, so 2 points, as we are between 8 and 10. And the enterprise value is a measure that gives us an indication of the financing of a company. So if you divide the enterprise value by sales, you can get an important ratio of estimating the valuation of a fast-growing but sometimes still loss-making technology company. So I divided the 29 billion US dollar market capitalization minus cash plus debit divided by the revenue, 3 billion. So we came up at 8.5, 2 points. The next KPI, the cross margin, 63%, 1 point, as we are between 75 and 65, and the cross margin it gives us an indication of the profitability of a business model, and the higher the percentage, the more money a company has available for sales, marketing, research, and other stuff like development. So 1 point for Twitter. Next one, the rule of 40 within the last 12 months, 15%, as we use the sales growth rate plus the free cash flow margin, and we end up at 15% roundabout. That's far below 40%. And the rule of 40 is a simply key figure for assessing the efficiency of a company growth and the quality of its business model. So the ratio is calculated as the sum of the sales growth, as I mentioned, and the free cash flow margin. And the higher the value, the better the business model of a company is. So here we would say above 40, and that is why a rule of 40 considered as an attractive business model. So in this case, 0 points. The next one, sales growth, as we saw before, 2.2%. That's a low figure, far below 20%, so 0 points. And here a screenshot from Yahoo Finance, the development of revenue from 2016 until 2019, also the development of earnings, quite a good performance. Next one, debit ratio 0.5. This is between 1 and 0.5, so 2 points, as we can see here in the HGI score. So we use the debit last quarter divided by the equity last quarter, and a debit ratio less than 1 is a low debit, while a debit greater than 2 indicates possible risk for a debit. So that's good and quite a good indicator to estimate the debit risk. Yeah. So the next one is the PEG within the last 12 months. So the PEG is one of the most important key figure for the assessment of an already profitable growth stock. It calculates the ratio of the price per earnings and the profit growth, and if the ratio is between 0 and 1, as Peter Lynch already mentioned, then it's a good indicator for an undervaluation of an stock. So it could be a very great opportunity to invest in a stock, as the stock is undervalued if the ratio is lower than 1. So the fair price indicates always an 1 as a ratio. So here we don't have any figures, as we had the EPS or the earnings per share is negative, so we can't use this KPI. So NA 0 points, and here below we see also the sales growth within the last 3 years. Quite a stable performance. And here within the published Q3 figures, Twitter beats the estimation by 0.13 cents, and that's quite a good result. So coming back to the HGI score, I explained it in other videos. So for every KPI of those 6 KPIs, we can get 0 until 3 points. So in total 18 points. And the higher the score, the better the gross investing analysis, or let's say it's an indication that we are talking about a high growth stock. So 18, it's the maximum that we can achieve. Here under these circumstances, Twitter's, let's say, not a high growth stock currently, with just 5 points. And as I mentioned before, they plunked by more than 20% after reporting the Q3 figures. And in addition to that, I use the EPS trend. So to give you an idea of the fair value price or the fair value of its price by Peter Lynch. So he multiplied the EPS multiplied by the gross profit growth rate. And here we see also in Yahoo Finance the EPS trend. So the current estimation is minus 0.86, as the next year estimation for 2021 is 0.8. So we talk about round about 200% profit growth rate multiplied by 0.8 cents US dollar. We came up at 154 as in fair price. So that's quite a nice opportunity. I mean, from my point of view, it not will grows very fastly to this value, but under these circumstances, just using the profit growth rate multiplied by the EPS, we came up at 150. So that indicates that we have an under valuation of the Twitter stock. So they are, from my point of view, undervalued, and it could be still a good opportunity or an implication that after this plunk of 20%, it's a good opportunity to invest into Twitter. Yes, that's it so far. I hope you enjoyed the video. Please feel free also to hit the subscribe button below, become part of the Monkey Stock Club family. I will keep you updated once a week on very nice investment opportunities, and it helps me to develop this community. And yeah, I would really appreciate to see you again. Have a nice day. Bye bye.